25 years ago, when I first sat across from someone explaining a balance sheet to me, I nodded along and understood maybe 60% of it. I don't want that for you. So consider this your onboarding. 10 terms. No fluff, no jargon for jargon's sake. Just the actual definitions, why each one matters, and a real example of it showing up in your life. I'm keeping this to the foundation on purpose. These 10 terms are the ones you need today, not someday. Grab something to take notes with. Let's go. Let's start with the word everyone thinks they understand, and almost nobody actually applies correctly. Asset. Technically, an asset is anything you own that has value. Cash, stocks, real estate, a business. But here's where it gets interesting. Owning something doesn't automatically make it a good asset. Wealthy people ask one follow-up question that changes everything. Does this asset put money in my pocket, or does it just sit there? A rental property that generates monthly income? That's a productive asset. A stock portfolio that pays dividends? Productive asset. Your primary home? Technically an asset on paper, but it's not generating you income. It's costing you money every month until the day you sell it. Here's your takeaway. Before your next big purchase, ask yourself that one question. Does this asset work for me, or do I work for it? Now the word that sits right across the table from asset, liability. A liability is a financial obligation, anything that takes money out of your pocket. Loans, credit card balances, your mortgage. If it requires a payment, it's a liability. Here's the mindset shift wealthy people make that most people never do. They treat liabilities as tools, not accidents. Debt used to buy a productive asset can build wealth. A 28% interest credit card balance and a 3% mortgage are both technically liabilities. They are not equally dangerous. So here's your takeaway. Don't just ask how much debt you have. Ask what that debt is actually buying you and whether it's working for you or against you. Equity is the value of an asset after you subtract everything you still owe on it. It's your actual, true ownership stake, the part that's really yours. Say your home is worth $400,000 and you still owe $250,000 on the mortgage. Your equity is $150,000. A lot of people get their net worth wrong without realizing it. They see the sticker price of what they own and feel wealthy. But equity is what's real. Equity is what grows over time as you pay down debt and as the asset appreciates. And it's the number you should actually be tracking. This is the single most important number on your entire balance sheet. Net worth. Total assets minus total liabilities. That's it. Not your salary, not your job title, not the car in your driveway. Net worth is the real scoreboard. I've met people who earn incredible salaries and have a net worth close to zero. And I've met people with modest salaries who've built real net worth over 20 years. Calculate your actual net worth today. That number, not your paycheck, is your true financial starting point. Liquidity is how quickly an asset can be turned into cash without losing value. Cash itself is perfectly liquid. A house takes weeks or months to sell. Net worth on paper means nothing if you can't access it when you actually need to. I've seen people who look wealthy on paper get completely stuck in an emergency. This is exactly why an emergency fund matters more than people give it credit for. It's about having cash you can access in an actual crisis. Don't just build wealth, build some of it in a form you can actually reach quickly, because a financial emergency doesn't wait. We're halfway through the list. If you're still with me, you already understand more balance sheet vocabulary than most people ever will. So let's keep going. A budget, technically, is a plan that tracks your cash flow, your income coming in, against your expenses going out. A budget is information. It's the only tool that tells you in hard numbers exactly where every dollar is actually going. I've watched people swear they don't have room to save, then track their spending for a single week and discover exactly where $300 or $400 a month was quietly leaking out. A budget isn't a punishment. It's the same tool a business uses to know if it's profitable or losing money, applied to your own life. Track every dollar for 1 week. Just one. You'll be shocked by what you find. Appreciation is the increase in an asset's value over time. Real estate in a growing area, a well-chosen stock portfolio, these can appreciate. Owning appreciating assets means your net worth can grow even while you sleep. It's the difference between working for money and having money work for you. But appreciation isn't guaranteed, and it isn't instant. It happens over years, sometimes decades, and it requires patience. When you evaluate a purchase, ask whether it's likely to appreciate or depreciate. That single question separates an investment from an expense. Depreciation is appreciation's opposite, the decrease in an asset's value over time. The classic example is a car. The moment you drive a new car off the lot, it can lose 10 to 20% of its value, and it keeps losing value every year after that. Most of the big purchases people finance, cars, boats, electronics, are depreciating assets. That combination, debt plus depreciation, is one of the fastest ways to feel stuck financially. When you're financing something, ask if it appreciates or depreciates. If it depreciates, keep the loan as short and the price as reasonable as you possibly can. ROI, or return on investment, is the ultimate yardstick for any financial decision. What you gained minus what you spent, divided by what you spent. This term is a mindset shift. It moves you from thinking about price to thinking about value. A cheap decision with a bad return is actually expensive. Wealthy people run this calculation, consciously or not, on almost every decision: education, tools for a business, even which car to buy. Before your next non-essential purchase, run the numbers. ROI doesn't just apply to money. A course that doubles your salary has a wildly different return than one that teaches you nothing. Last one, and it might be the most important term on this entire list: amortization. Amortization is how a loan gets paid off over time. Early in the loan, the overwhelming majority of every payment goes toward interest, not the actual balance. This is exactly why an 84-month car loan is such a trap. You're paying mostly interest for a big chunk of those years, on an asset that's depreciating the entire time. Understanding amortization changes how you think about extra payments. A small additional payment toward principal early in a loan can save you significant interest. Pull up your loan's amortization schedule and actually look at how much of your payment is going to interest right now. It might change how you feel about that extra $50 a month. 10 terms. Let's run through them one more time, because repetition is how this actually sticks. Asset, liability, equity, net worth, liquidity, budget, appreciation, depreciation, ROI, amortization. These aren't just vocabulary words for a quiz. They're the actual lens wealthy people use to evaluate every financial decision. And now you're using the same lens. This is the foundation everything else on this channel builds on. When I talk about traps, I'm really just showing you these 10 terms in action over and over again. I put together a free balance sheet template, links in the description, so you can actually apply everything you just learned. Don't just watch this video and move on, use it. If this is the first Alex Explains Money video you've watched, welcome. This is where you start. And if you've been here a while and just needed the vocabulary to finally click, I'm glad this is the one that did it. New videos every week. Subscribe, and I'll see you in the next one.